Hello, this is Henry Becker with Lighthouse Wealth Management, Director of Research. And as you're aware, we do kickoff events every year, beginning of the year here in Maryland, and we've been actually doing some in Florida as well the last 2 years, in Naples that is. And we often get clients asking for the slide deck or for us to record the slide deck and so forth. So this year, I figured I would go through the majority of the slide deck and try to do it in less than 10 minutes to save you some time, and you'll get more or less the gist of it, less the questions and some of the back and forth with clients that happens in the actual meetings themselves. So with that said, I'm going to get right into the slide deck for 2019, which the theme was A View from the Crow's Nest. So S&P 500 this past year was down 4.59%. This is 2018 numbers, by the way. U.S. aggregate bond index up 0.10%. Russell 2000 down 11%. Commodity index down 13. MSCI International, which is developed markets, down 13. Emerging markets down 15. And the blended index, LWM, Lighthouse Wealth Management, blended index was down 7.23. This is basically something we use internally just as a benchmark to give us an idea of what a diversified portfolio would have done in the past year. All right, you can take a look at some of the disclaimers that we're required to put out there. Just kidding. 2018 summary. So 4 points that... 4 key takeaways from 2018. Volatility on the rise. So as you definitely saw at the end of the year, but throughout the year, 2018 was roughly six times more volatile than 2017. And what we look at really to kind of gauge that is in 2017 we had only 8 moves of 1%, either up or down. We had 8 1% moves in the S&P 500 in 2017, and we had way more, almost 6 times that amount in 2018. Tech in check. What we're looking at here is, as you probably are aware, tech stocks took a bit of a beating this past year, meaning the share prices, but some of the companies took a beating as well, like Facebook and Google, with privacy issues. Small number of stocks lead. This has been the case for the last few years now, where it's less than 10 stocks that are really driving the majority of the movement in the S&P and the NASDAQ. And then a foreign funk, what we're pointing to is that we are looking at what might be the beginning of a global recession with countries like Japan, Germany, France, Italy heading in that direction. But the United States has been steady from an economic standpoint. So in this chart, what we're looking at is global GDP. We're tracking it. It's weighted global GDP. The orange line is the total of the BRICS, which is Brazil, Russia, India, China, South Africa, developed markets, and then the green line in here is other emerging markets like Saudi Arabia, Peru, Argentina, and so forth. So, but what you can see, what we're really focusing on is the right side of this, and we're seeing a slowdown beginning in the global economy. Now, that doesn't mean the United States is going with it, but it does mean, as part of the world economy, we're susceptible of being dragged down with the others. This little chart, 2018, what we're looking at is the best of basically the G20 for the most part. The best market return was New Zealand, which was barely eking out a positive return, to the worst market, which was Turkey, down 41%. 2019 outlook for headwinds and tailwinds. Headwind, interest rates. As the Federal Reserve has been ratcheting up rates, we've seen the rate of change at least in the U.S. stock market, has changed dramatically. The Fed balance sheet, as you're probably aware, the Federal Reserve's balance sheet has ballooned from $800 billion back in 2008 to over $4 trillion. That's with a T. currently, but the Fed has been reducing that balance sheet, which means liquidity or money is starting to leave the system. And as you might be aware, what the Fed does kind of greases the monetary system. So if they're pulling money out of the system, then they might be tightening things up. So tariffs, I'm not going to belabor that point very much. If you read the newspapers or watch the news, you know what's happening on the tariff front. Global slowdown, we've already touched on. Tailwinds, things that are going to help the economy, hopefully, is a strong U.S. consumer, because we are mostly a consumer-driven nation. A correction could be healthy. What we saw happen at the end of the year, although painful to watch, has been long overdue. We haven't seen a 20% or more correction in stocks for quite some time. Sometimes that resetting allows investors to come in and start putting money to work. Corporate profits are still growing, and inflation is in check. Those are all positives for the market. So as we just talked about, we see the blue line is the Federal Reserve raising interest rates, currently at 2.4% on the Fed funds rate. And then the orange line is the Fed's balance sheet, which is just a little over $4 trillion at this point, but as I said, has been coming down. So in 2019, we expect, and it's already been happening in the beginning of this year, a lot of the changing of the guards, which would be mergers and acquisitions. And what we have is some big old school companies like Altria, which is more or less the big tobacco company, amongst some other things. But with the idea that more and more people are not smoking and trying to diversify their business, they've taken huge stakes in cannabis companies like Cronos and in e-cigarettes, which companies like Juul. Then we have a company like IBM that has been a laggard as a tech company for the past couple of decades. Seems like they've probably thrown in the towel and trying to revamp themselves, and they bought Red Hat, which is the maker of the Linux operating system and a huge cloud computing company. And then what we're also seeing coming up is the sharing unicorns are slated to go IPO, initial public offering, in 2019. That would be Lyft, Uber, Airbnb, and Slack. And lastly, another item driving the market is the changeover for a lot of companies to subscriptions. Companies like Adobe, where you used to buy a disk from Adobe to be able to access PDFs or create PDFs. Now you don't just buy a disk one time, you pay a monthly subscription. And then also you have the similar with Waymo, which is the arm of Google that's generating the artificial intelligence cars. They're discussing or putting out there that the idea of subscribing to a car service versus owning a car. So what does it all mean for the markets? The Lighthouse, continues to be bearish on bonds in the medium and long term. We do hold some bond positions, but they tend to be in the short-term nature, so they're less volatile to interest rate moves. And on the stocks front, we're cautious in the short term, but bullish medium to long term on stocks. So investment terminology, some things you might be hearing more of, and some of the history behind it. These four terms: yield curve, recession, bear market, and correction. Yield curve is basically this red line you see here, and it's basically the different yields of U.S. Treasuries based on different maturities. Typically, this should be a curve going from the lower left higher as you go to the right. So you would have lower short-term rates and higher long-term rates. But what we're seeing is a flattening of the yield curve lately. And a flat yield curve or inverted yield curve often is a sign of recession. So we're keeping an eye on the yield curve. So what is a recession? A recession, there is no standard definition, but a common definition is 2 consecutive negative quarters of GDP growth. But like I said, there's different definitions, but typically 2 negative quarters of GDP is a recession. Bear market. Bear market is where the market falls by 20% or more. Since 1945, it's happened 11 times, and we've had an average decline of 30% with a peak to trough of 13.2 months and an average recovery period of 22 months. And a correction. Correction is typically defined by a 10% move lower. And since 1945, we've seen 26 of these, with an average decline of 13%, a peak to trough of 4 months, and an average recovery period of 4 months. So there you have it, the primary slides in our slide deck for the 2019 kickoff events. As always, if you have any questions, issues, or concerns, please feel free to reach out to us. I thank you for your time, and we hope you have a very happy New Year.